Welcome back to Equity and Ag, your afternoon check-in on the grain and livestock markets. Let's walk through how things shaped up today across corn, soybeans, wheat, and cattle. Corn futures moved lower on Monday, largely reacting to improved weather outlooks in South America. Forecasts are calling for multiple rounds of rain across Argentina over the next 2 weeks, with the second week looking especially favorable. That moisture is easing some production concerns and adding pressure to prices. U.S. export demand for corn continues to look strong overall, but competition is becoming more intense. Corn out of the U.S. Gulf is currently priced above supplies from Brazil and Ukraine, which could limit future sales. Looking ahead to Tuesday's WASDE report, traders expect U.S. ending stocks to come in near 2.26 billion bushels, which would be the highest level in 7 years. There is a possibility USDA raises its export forecast, but that could be offset by lower feed usage and rising global corn stocks. Argentina's corn production estimate is also expected to increase. Meanwhile, higher corn prices have made alternative feed grains more attractive, with Black Sea and Argentine feed wheat now cheaper than corn. In Brazil, planting progress for the larger safrinha corn crop continues to move quickly. Mato Grosso, the top producing state, is now close to 30% planted. Even with recent rains, soil moisture levels remain historically low, which bears watching. On the export side, U.S. corn inspections remain well ahead of last year, up more than 400 million bushels. Managed money is estimated to be holding a net short position, just under 60,000 contracts to start the week. Soybeans and soy meal moved lower on Monday, while bean oil pushed higher alongside crude oil. March bean oil futures climbed to their highest level since last summer, supported by strength in energy markets and optimism surrounding potential U.S. bean oil purchases by India. Biofuel production continues to be a supportive factor, with cumulative output through November ranking as the second highest on record. Industry capacity is still expanding, with production capacity for late 2025 projected to be nearly 10% higher than a year ago. On the bearish side for beans and meal, improved rain forecasts for Argentina, an accelerating harvest in Brazil, and weaker Brazilian export premiums all weighed on prices. Brazilian soybean offers are now more than $1 per bushel cheaper than U.S. Gulf values. That said, there was a positive export headline early Monday, with private exporters reporting a new sale of just under 10 million bushels to China. Whether that leads to additional purchases remains uncertain, especially given the current price advantage held by Brazil. U.S. soybean inspections remain well behind last year, down more than 400 million bushels so far. Brazil's harvest continues to advance rapidly, with Mato Grosso nearing 40% complete. Expectations are that Tuesday's WASDE report could raise Brazil's soybean production estimate by 1 to 2 million metric tons. Speculative funds are estimated to be holding a sizable net long position in soybeans to start the week. Wheat markets also trended lower again, with Kansas City March futures posting losses in most recent sessions. Paris milling wheat futures are hovering near contract lows, reflecting ongoing global pressure. Despite price weakness, U.S. wheat exports continue to outperform last year's pace, with sales commitments running nearly 20% higher. That opens the door for USDA to potentially increase export projections in the upcoming WASDE report. However, U.S. wheat remains at a pricing disadvantage on the global market as supplies from Argentina, Russia, Ukraine, and parts of Europe are currently cheaper. Funds are still carrying a large net short position in Chicago wheat. One supportive factor being monitored closely is dryness across portions of the U.S. plains. If those conditions persist into late March, weather-related risk premium could start to build. From a technical standpoint, Kansas City spot wheat is holding just above key moving averages. The cattle market continues to show long-term bullish potential, but near-term volatility remains a reality. Recent headlines and broader economic uncertainty have kept risk elevated, as demonstrated by last week's sharp moves. Cash trade activity was lighter earlier this week, partly due to disruptions from the recent winter storm. Auction volumes remain somewhat reduced, particularly in major markets like Oklahoma City and Joplin from the storm. Even so, prices have generally been strong. Calf prices at many auctions were reported $10 to $20 higher compared to 2 weeks ago, while trades compared to last week were typically $5 to $15 higher. Yearling feeder cattle were steady to modestly higher. Overall, price action continues to vary widely depending on location, demand, weather conditions, and cattle quality. With warmer temperatures returning and transportation improving, producers were able to move cattle again and were met with solid buyer interest. That rebound in demand following last week's storm appears to have provided another bullish spark for the market. Disclaimer: this content is for informational and educational purposes only and should not be considered financial, investment, or trading advice. Market conditions can change rapidly, and all trading involves risk. Always do your own research and consult with a qualified professional before making any financial decisions.